Thank you so much for being with us. So I'm Raphael Bloch, co-founder and CEO at the Big Whale. We are the leading European market intelligence platform dedicated to digital assets. Really happy to be with you on stage. There are many subjects that we want to talk about. We have 40 minutes. I would like to start with you all with a quite direct question. Do you think that regarding the context, especially the macro context with higher rates, geopolitical also troubles, and the fact that crypto market is not, I would say, in its best shape, do you think that this is really the right time to integrate digital assets in institutional portfolios? I would like maybe to start with you guys, Kathleen, Nikhil. Kathleen, if you want to start. Yep. Oh, you need a mic.
For sure. And Raphael, when you said that context, I sort of reckon that you are focusing more on Bitcoin because from a geopolitical context and current disorder, uncertainty, what exists, Bitcoin sort of fits the bill in terms of the framing. So Bitcoin in and of itself is sort of an asset in its own category. It's an asset of one. It's generally been perceived as digital gold. It's been looked at as a portfolio diversifier, providing mainly because it's sort of it's a decentralized, scarce instrument, which is not really beholden to any sort of geopolitical, sovereign economic construct. And that's why most of the investors have been looking at it as potentially providing a diversification against political uncertainty, geopolitical uncertainty, higher rates, and generally currency debasement. Which is why in the last 12 to 24 months at least, we've seen more and more investors getting warmer to getting allocations on Bitcoin. We've seen that on our own ETPs as well, where we have seen several institutions sort of coming on board. That said, I think if you put that in perspective, this might be the right time to kind of potentially look to allocate to Bitcoin. That said, the why and the how needs to be very clear when an institution or institution type sort of look at it. We've made the how sort of clear over a period of time by creating familiar, trusted structures through which institutions can get access. I'm talking about exchange-traded products, exchange-traded funds here. The why continues to be that Bitcoin needs to perform consistently in a way that it's perceived as a portfolio diversifier for institutions to have that conviction to kind of go ahead and allocate to it.
On this, Kathleen?
Yeah, and hi, great to be with you all today. Kathleen Wrynn, Global Head Digital Assets at Invesco. I would absolutely agree with Nikhil. I think that when it comes to ETPs, they're a very easy and familiar access point into digital assets. I think of the how is very important because thinking of how this is really kind of changing how asset managers operate over time and the potential products that investors can get access to, it's really a spectrum. So on the one hand side, the crypto-linked products through traditional wrappers like ETPs are a great way to do so, but at the same time, so are tokenized offerings. And so being able to provide both is really critical that asset managers engage in a meaningful way now.
And Jason, so about multi-portfolio asset strategy, where do you put those Bitcoin ETPs as an asset manager?
Yeah, firstly, thanks for having me on the panel. Jason and Xavier, I look after ETFs for Europe and Asia. It's on the capital market side of Franklin Templeton. So the first thing, and agree with Nikhil and Kathleen, that you've got to separate the sort of price action of the current assets out there versus the structural change that's going on. The once in a generational shift. Is it the right time to be investing? And is it the right time to be putting and having a conversation with clients around, distributed ledger technology and blockchain? 100% it is. Okay, if you look at even the mutual fund, the 40 Act mutual funds, they came out of the 1930s Wall Street crash. If you look at ETFs, they came out of the 1987 Wall Street crash. Now, I'm not saying that this crypto winter is a crash, but it's certainly a time for investors to start looking up and looking at the current offering and understanding in ETPs getting that exposure versus what's coming. And getting comfortable with the current offering for really what's coming. That structural shift, now's the time to experiment. Now's the time to have a look. Now's the time to potentially look at the price action relative to what you've seen in the past and integrate that into your portfolio. Franklin Templeton, you guys can go away and you can Google this. You can look at our groups. We've got a fantastic team on the digital asset side. We've got a fantastic team on the multi-asset side. Can you believe it? We are now at a crypto conference and we are talking about Bitcoin and Sharpe ratios, or at least we will be. Okay, This is progress, guys. This is like 5 years ago. You guys were begging for this. Institutional grade product. How do institutionals start investing and using these assets? Well, guess what? We apply exactly the same metrics as we do to traditional listed securities. We look at the risk return profiles of our individuals. Are they aggressively attuned to risk? Are they moderate? Are they conservative? And we select portfolios and we allocate on a risk adjusted return basis. And our research has proven that if you put a 1% allocation to Bitcoin, you increase your risk return, you increase your Sharpe ratio. If you embed that within the benchmark so that you start now looking at your active risk versus just an out benchmark bet, you completely see the benefits. So I would say 100%. I don't think there's a correct time either way anyway, but I'm encouraged by the fact that we're now on stage talking about real sort of TradFi metrics for inclusion of these sort of products.
And Ben, before the panel, you told me that, maybe this is the right time to accelerate on those kind of products because it's now with the institutions and also the fact that, the market is now in a down slope, but I mean, still not progressing that much. So do you think still that this is the right time to go in this market?
I love the fact that we are 5 minutes in and we talked about Sharpe ratios. Fantastic. So Ben Slavin, I'm the global industry lead for ETFs for BNY. And the short answer is yes. I think what we do see is a lot of money in motion, obviously this past quarter, with given all the market volatility, not just in digital assets, but asset types really across the board. And when you actually look at the data, at least from an ETF standpoint, you actually notice that the flows have turned slightly, but positive, which is an interesting sign. I think potentially gives you some indication of investor sentiment, but also it's a little bit different. And I think the message is also, again, back to sort of Jason's and some of the other points made, a preference for that institutional grade product and a delivery mechanism, in this case, the ETP wrapper, that is something that investors, want. And clearly there's demand for the product. So some of that noise in the market or in that data is in part just that structural preference moving towards the ETF. I think also, there is another element to this. And again, something else that I think is incredibly important, and I'm sure will come up, is just that ability to have greater access by investors. And certainly you're just seeing the ETPs and also being able to invest natively more widely available to investors around the world. Part of that's regulation, part of that is technology, and part of that is just the ability for these investors now to include products like ETPs in their asset allocation models, which just really wasn't even the case just a couple of years ago.
And about this, how you assess, in terms of allocation, if you want to put 1-2%, maybe more in your portfolios on this, Nikhil?
So we've had a method where we've taken like a risk budgeted approach, and that's what we typically have seen like investors do as well. So most investors coming into our ETPs and most institutional type investors that we see are starting with a risk budgeted approach of like 1-2%. But then some institutions have gone to sort of 1-3% as well. There isn't almost like a golden bullet or a silver bullet in that in terms of what the allocation should be. It really depends on how the institutions look at the asset itself within their portfolios. And like if we think about it, like has it been sort of a structural sort of change in terms of how investors are looking at it? I feel it still needs to sort of be looked at over a period of time in terms of how institutions allocate it. What we have seen, however, is there has been resilience from institutional investors holding our ETPs. So especially if you look at the period from October, when there was a crash in the market, when there was sort of a cascade deleveraging within the market and like price action going negative. If you look at that period from October 9th, October 10th, when about 21 billion, close to that, was liquidated in the market, the period from then to now, there's been almost a tiny outflow from our flagship ETP, IBIT. And if you look at the beginning of this year, especially, which hasn't been great for Bitcoin, IB1T, which is our European ETP, has actually seen two of its strongest weeks in this year. So if we look at broadly how investors are sort of looking at it, they're definitely continuing to sort of believe in the thesis that Bitcoin continues to be a diversifier. They need to see this consistently over time. And like when you put that in perspective, the general larger institutions have been pretty stable in terms of how they.
And you only mentioned Bitcoin. For Ethereum, Solana, and other. Is it something also that you are considering? Yeah, Jake, go ahead.
No, we do have a Ethereum ETP. We look at those products, Bitcoin ETP, Ethereum ETP, as your beta play in this space. Again, bringing it back to sort of TradFi. Unfortunately, I know it goes against some of the core beliefs, but bringing it back to TradFi, it's beta for the market. So what comes next after beta, alpha? So it should be no surprise that, this panel and other asset managers are looking at how do we create alpha? We've now got the sort of beta sleeve. How do we create alpha? And how can we present that in a proper framework with the right risk-adjusted returns? And as we said earlier, the risk budgeting approach, Nikhil said the risk budgeting approach, we take the same approach. We say, look, you've got people that have a really, really cautious view. You have people that are super aggressive. Now, 100% equities or 60-40 portfolio, the only other component we say is you take that risk budget out of high-risk equities, emerging market equities, high-yield bonds. That's where you're allocating. You're not allocating just solely absolute to Bitcoin. You're taking it away from other risky assets and applying that into the benchmark, having had that conversation with the client, the investor, around their risk tolerances. And then you can really see how much risk they're actually taking and you can dial it up or down.
And maybe just to add to that, I think in addition to kind of traditional valuation models that we apply to digital assets, I think it's exciting as well, kind of introducing network economics as well, thinking of, adoption, usage, fees for each of the respective assets, and then thinking also how where we're going is moving from, the narrative changing from not if, but how. And I think to your point, Jason, on like how you're going to reallocate to crypto assets from other parts of your portfolio.
So you mentioned ETH as well. So we do have ETPs as well, one on direct exposure to ETH and one staking ETP. But generally, to Kathleen's point earlier, I think when investors look at Bitcoin, they look at different sort of risk return characteristics versus when they look at ETH. ETH is a tech play. So then the conviction that an investor comes with in terms of when they allocate to these ETPs is very different.
I was going to add, from our perspective, just to tack on to what was said, I mean, certainly we've seen the popularity in spot products. I think you mentioned, sort of alpha generating products. We're sort of in a fortunate position, sort of supplying the infrastructure and services to more than 80% of the global ETP market in terms of assets. And so we get to see a little bit of everything. And I think also one additional sort of twist that we're also starting to see, which is a sort of a tried and true playbook for ETFs really around the world, is different sort of iterations where you are looking at investor solutions, things that are adding digital assets plus income using options. Obviously, we've seen the launch of some products that use staking, products that have a hedge. So investors are also looking for not only that access, but also packaged solutions, which again, something we've seen in the market, but now we're starting to see those come into play, with these assets.
Okay, thanks. And so, Mike, you are the crypto native player on this front table. You went public last year, congrats. When you launched BitGo and worked on it, have you ever thought about a market driven by financial institutions like the one we have in 2026?
Yeah, look, I think for pretty much everybody that's been in the digital asset space so long, actually, it's incredibly exciting to have this cast of characters from the companies that they all represent discussing these topics. With regard to like Bitcoin, Ethereum, and then kind of the long tail of things that come. So BitGo, we're a crypto native company. We started with wallets years ago. We have an OCC chartered national bank who run 7 custodial banks around the planet and provide services from trading to staking and everything else on top of that. What we have seen in terms of the adoption, because we're powering behind the scenes for a lot of the traditional players, everybody comes in first for Bitcoin, and then they start to look a little bit at Ethereum. And then the long tail, it's going to take more time. Certainly the last 4 years when we had a different regulatory scheme, Bitcoin had a safety net being fully decentralized that the other chains did not have. So it was even harder to touch. But if you take a look at like how people have tiptoed into the water, Fidelity, I think, is a great example. It doesn't get enough credit. They got into this space 10 years ago, right? Started doing Bitcoin. They've since added Ethereum over that course of 10 years. And then they're barely getting started kind of into the next step. So I think things are going to kind of adopt a little bit slowly that way, but it's exciting to have this thing starting at all. It's fantastic. It's going to open up the space. It's going to make it more accessible to everybody. And then finally, hopefully we get to some of the realization of how we can make markets just better.
Yep. And about the stablecoins, so we know that stablecoins are a really good way for traders, to buy and sell crypto and then buy and hold actually. Have you seen this move also from more the institutions to use stablecoins like a liquidity tool on the market?
From the traditional institutions, not as much. So we offer a stablecoin as a service product. We have a number of parties that have already announced that they're using our product. So SoFi Bank is one that's announced their own stablecoin. There's more that are coming. And then what we provide at BitGo is we're kind of like the correspondent bank for stablecoins. So the traditional banks that just want to touch dollars, they can touch dollars. They send all the stablecoins through us, and we'll give them back the dollars one way or the other, whichever way they're trying to go. But for traditional finance, not as much stablecoin adoption as of yet. And I think it's in part because traditional finance already has all the USD rails. But we'll see how that grows, because the stablecoins are definitely much easier on global access.
So even for payments or yields, you don't see that much usage?
Not by traditional finance yet.
So are you working on stablecoins, guys? Specific usage?
Not directly. The way we position with stablecoins is we are a reserve manager. So we're the largest non-bank reserve manager for Circle USDC. And also we look at stablecoins as almost the payment cash mechanism for which a complement in terms of investment cash is needed, where we plug in our money market funds. So the way we work with stablecoins today, and this is something that we've seen in our tokenized treasury fund in the US, is investors can basically hold yield for the time they remain in the fund. And the time that they actually need the payment cash for their payments obligations, they can just swap one is to one with a stablecoin and just get out. And that we feel is a very compelling proposition from a liquidity management standpoint for like treasurers in general. Because if you think about treasurers wanting to move money like cross-border, cross-entity just in time, they could do that potentially with stablecoin, like the point that was mentioned. But today, in most jurisdictions, stablecoins don't really give you yield directly to the issuer, or directly to the customer holding it, which is where the interplay between a tokenized yielding product, such as our money market fund, and the stablecoin becomes quite a compelling proposition. So generally, our positioning is where we can provide backing to a stablecoin and where we can use it for settlements rather than issuing ourselves.
If you think of where stablecoins are today, over 80% of all stablecoins on public chains are currently through two main issuers. We anticipate with more regulatory clarity, especially in the US, other jurisdictions as well, Hong Kong recently, to really have more institutions issuing stablecoins. What that means ultimately is we're going to have more tokenized fiat, digital money on chain. So while the key applications right now may be payments and collateral use cases, we're very excited to want to have more reasons to put that money to work in the form of tokenized funds. And that's why we're very excited to have announced a few weeks ago, partnering with Superstate to take over their tokenized money fund, USTB, to become the investment advisor, and hopefully gaining more institutional adoption as we have more tokenized fiat on chain.
Yeah, it's a very similar scenario, Franklin, and a shameless plug. We're all going to be plugging our products, but we effectively have an on-chain money market fund as well that gives you intraday yield. So where do we see value? We see value in the collateral space. We see value in opening up that institutional collateral opportunity. That, for us, is where we see these first tokenized instruments, let's say. The first step into this world is, for us, money market funds. And we're seeing good traction there, and we think that, for us, is the core.
Yeah, I'll just add, I think just to kind of maybe bring some of this all together, we certainly, I think Mike raised some great points, and we see some of the same trends that you do for sure. But I think on the other side, we see, again, from the panelists here and clients that we represent, an incredible amount of demand to try to bring some of these innovative solutions, provide, effectively a bridge, and provide some of the things like you were just mentioning about, bringing products with yield, trying to bring something better to the market that could, really try to differentiate some of the product and help to attract some of that business and some of those assets, over to these new products. And so, we are in the business of providing a lot of that infrastructure and capability to enable our clients to do so. So we see that demand, and then, obviously there's a lot of expectation built in that obviously the assets and the client demand will continue to follow given where things are at today.
I just also add that this example is a great example of the ecosystem enhancing the features of a TradFi instrument. Okay, so a money market fund pays you a yield on a daily basis. So if you sell that money market fund in the morning, you no longer have a piece of that yield. The technology and the ecosystem we're now in can give you yield on a second by second basis. So I could be holding Benji now and I could be transferring it in an hour and I've got half a day's worth of yield. The next counterpart picks up the other half. I mean, that's an enhanced feature. Now, if you're having a conversation with a treasurer around allocating, excess capital to a money market instrument, can you see where that conversation goes in 2 years? That treasurer is not going to be saying, okay, I'm going to use the traditional money market fund that you guys are offering. I'm obviously going to use the enhanced featured one. And it just happens to be in a completely different ecosystem. So back to the first question, getting that treasurer comfortable in this crypto winter is a decent sort of strategic position us.
And what difference do you make between stablecoin and money market fund, actually, tokenized money market fund, in terms of cash management and maybe in terms of allocation in your portfolio? Would it be possible to have, on one hand, stablecoins in your portfolios and also money market funds?
So look, I think the stablecoins, there's an ease with stablecoins at the moment, okay, and that's the big hurdle. So while we have all these amazing products, we still have to onboard KYC, we have to do all of that DD, whereas stablecoins, it's so much easier at the moment. So once we get to that point, then I think, you'll see an acceleration of money market instruments potentially being used.
And so we talked about the ETPs, stablecoin. Do you see those products like the opposite way, maybe to balance your portfolio? I mean, if you have some cash, so stablecoins, and also an exposure to Bitcoin and ETH. So do you think that you have on one hand more maybe yield and risk, and also a way to mitigate this risk in your portfolio?
I'll just say, I mean, there's a lot of different angles to play here, and certainly ETPs are really, to me, a bridge in many ways. What you are seeing in the market, without a doubt, is more choice is coming to the market. So we just were talking about for the last several minutes, all kinds of different options that are becoming available to investors. So certainly ETPs being one. We talked about some of these other solutions, and I see obviously more of that coming. I think we probably all do. In terms of the ability to use some of these products, for example, to hedge, I think, certainly that is one of the many benefits or hallmarks to ETFs. And I think part of that also is just that it is through, obviously, on the traditional rails or using the traditional financial infrastructure. And a lot of that trade that we see is simply out of convenience, just something that is easy at the moment for investors to access in certain cases where moving money on and off chain doesn't have that friction for those clients who are able just to, again, access those. And again, there's just more choice in the marketplace, which ultimately is good for investors.
And in terms of risk management, how do you operate with on-chain and off-chain products as an asset manager? And also, Mike, on this, how are you working maybe with your partners to help them to manage this on-chain, off-chain products?
Well, let's see. In terms of the on-chain products, one advantage you have is super easy audit capability. So let's see, on the stable coins, obviously that's got an on-chain and off-chain component. The on-chain, you can always see, actually the public helps you audit that all the time. On the back side of that, with the stable coins that we do, we audit them twice a month. I don't know of any other traditional financial product you've ever done twice a month audits. So pretty strong there. In terms of how people are managing overall audits, this is a challenge actually for the auditors as well. Do you actually own the asset? Are you sampling? Are you actually proving ownership, et cetera? Yes, we provide a lot of consults on this. I think people are still learning, but it is moving along.
So how are you learning to do this?
I mean, we have implemented. So if you look at our ETPs, it goes through our risk management systems, which are off-chain systems, if you will. If you look at our tokenized products, and if you look at the tokenized products that we continue to sort of look at as well, the transfer agency systems, which are sort of critical to sort of maintaining the books and records of the fund, depending on which jurisdiction you're operating in, it may or may not be completely on-chain. So you could hold the investor register, potentially the address is on-chain, the transaction register on-chain, but a good part of the investor identity actually sits on the off-chain, which means you need to have some kind of a mechanism for the on-chain to interact with off-chain while going through all the risk management principles that we apply for all our traditional products. Because tokenization, and it's sort of a new sort of business line for all of us here.
Does BlackRock provide on-chain proof of reserves?
We, for our
Bitcoins?
No, we don't.
Oh, how come?
We don't yet.
Oh, are you going to?
Well, let's talk.
Yeah, maybe just to add to that, I think, from our view, we view that partnerships are critical to kind of help bridge the best of both worlds in a lot of ways between on-chain and off-chain. So just again, looking at Tokenized Money Fund I mentioned earlier, kind of leveraging super states on-chain infrastructure to bring our kind of expertise around investment management, risk management, product governance to help combine both capabilities. Similar ETPs in partnership with companies like Coinbase, with Galaxy and CoinShares.
Jason and Ben on this.
Yeah, look, I think the ETF wrapper actually takes out a lot of the complexities here, right? So I think, as Ben said earlier, and as I was walking in, I saw the catchline of this conference, the bridge to the digital world. Well, as we sit here and talk, if you guys want to get exposure, if institutions want to get exposure, the bridge at the moment is the ETP. Okay, so you all want to get to Web3, but Web3 rails are not ready yet. The only rails that TradFi are working off of are ETP TradFi rails, but through the ETP. And this, honestly, 10, 15 years ago, I was on panels talking about the benefits of an ETF, the benefits of the daily transparency, the intraday liquidity, the cost efficiency. Well, guess what? It kind of feels similar. We're exactly saying the same sort of stuff. It's just now in a completely different ecosystem. But the bridge still exists, and that bridge is currently the ETP. And it really does collapse a lot of that complexity outside of other stuff.
Yeah, I think, again, the bridge, I think, is ultimately the way I think about it. And as you were talking, it brings me back, same thing 15 plus years ago, marketing ETFs. And I used to always talk to, traditional managers, usually in a mutual fund or some other commingled structure. And I would always make the terrible joke that I come in peace. And I sort of feel that way from, coming from an ETF angle and talking to, this audience and others. Ultimately, we come in peace, that we're part of the ecosystem. We're part of that solution. And again, it adds just another way and another dimension to bring, again, as I mentioned, some more choice. I do think, though, one other great points raised, but the other piece that is important is really to, again, continue to look forward. And I look forward to advancing some of the regulatory schemes in different markets around the world that ultimately will provide more clarity. So certainly a lot of the complexity, there's benefits, certainly, or at least well-established guidelines, at least in traditional markets for regulation. But this is something new. And I think more of that clarity, more development of the regulations will ultimately help, again, bring some of these two worlds together, but also provide more comfort for investors, either to use ETPs or to invest natively.
Yeah. And Mike, do you think that, so we have those traditional rails and new on-chain rails, do you think that they will merge? How will, these products will look like in the coming years? And actually the question is for all of you, but Mike, if you could start.
Well, I wish I could answer how it was all going to look all down the future. Certainly, look, every traditional firm is experimenting with digital assets in one way or another. I think today you're looking at it kind of behind the scenes of traditional wrappers. But then hopefully the next phase is where we start to say, well, what's actually better about this? So whether we're talking about on-chain proof of reserves, of course you should have on-chain proof of reserves. Sorry, I don't want to criticize. But it's a new thing that wasn't possible before, so you didn't have to think about it before. It's never been doable until now. So hopefully those things come to life on stablecoins and payments, in-kind deposits and conversions. Hopefully all are useful and come to light as well. And then lastly, mention DeFi a little bit. DeFi is still outside of the realm of touchable. We had some good SEC news yesterday in terms of how you might be able to trade on those platforms from a completely self-custodial manner. On the institutional side, probably custody is always going to be a requirement. And this has to do not with regulatory requirements or things like that, but just business continuity. If you run a business, you want to know that you have your money and there's no single person that can kind of lose it accidentally or fraudulently. So anyway, I think there's more to come, but it starts with getting started. So it's great to be in the game.
And back to your point, Ben, don't you think that, ETF was a big revolution in terms of distribution products? Don't you think that the token will be the next, like ETP or ETF for finance?
Yeah, certainly, as you sort of alluded to, ETFs are or have been a disruptor to the industry. there is no doubt that this has the potential to do that once again in terms of being able to consume these types of products, on chain via a token or some similar structure. But it's going to take some time, certainly for us to get there. I think in this particular case, what you're seeing is obviously everything moves fast these days, but everything is moving fast from a technology standpoint. But it does seem at the moment to be sort of outrunning, obviously, some of the market structure to be able to support it. And as I mentioned, to some degree, some of the regulatory, at least framework or clarity to be able to really see mass adoption, to say that the disruption is right here on our doorstep. I think we have, some ways to go, but certainly you can look forward to the future and see where things might be going without a doubt.
Kathleen, on this?
Yeah, I think this is an evolution. I think we are in the early innings from a traditional finance perspective. ETPs, one thing we didn't touch on is, I guess, from a security perspective, having investors being able to access digital assets without having to actually, manage their own wallet or private keys. That's really a big benefit that, as issuers, we custody in an institutional grade manner. That's going to evolve over time, as they want different ways to custody their assets, as they want different delivery mechanisms through tokenized assets to also put that money, to be able to work in different ways. But that requires us managers to really create a net utility for those tokenized offerings to make those products a net better product than the traditional product, to want to foster that convergence between traditional investors wanting to hold a tokenized format. I think that's something that we're all actively working on.
Okay, thanks. So just to wrap up, according to you, what a typical portfolio allocation will look like in the coming years towards digital assets? Nikhil?
Portfolio allocation together with like traditional assets. So I'll stick with the line that we use right now. It's 1 to 2% for Bitcoin. Beyond that, for crypto assets that you have, potentially going to like 1 to 3%, which we see across in investors. You asked a question about stablecoins earlier, and I almost look at the definitions need to be aligned in terms of what you're using them for. So when you look at ETPs, where you're getting access to sort of an alternative asset class, that's a different sort of proposition from how you would get access to stablecoins as a payment instrument. So I don't look at them the same way.
I think 100% is going to be digital because we're going to wrap everything digitally. So I don't think we're that far away from it. It turns out that there's a huge need for open standards around how the technology interoperates between firms, and the way you do that is with digital assets. So stablecoins on payments, I agree, it's not really much of an investment thing. If you want to have like an alternative when you're in your brokerage, I guess you can use a money market, probably be just fine. Have a tokenized money market. We'll have tokenized deposits at our banks that will be convertible into tokenized stablecoins that you can use when you're paying internationally. And then of course your investments are going to be tokenized as well. So that's what's going to drive 24/7 markets.
Yeah, I agree. As a capital markets ETF guy, 24/7 markets is massively exciting. If you think about where we're going, if you think about what currently is out there, it's really small relative to where this is going, right? It's about giving investors choice, giving investors access, giving investors diversification. I had a conversation with my son about a football team that are looking to tokenize a sleeve of their revenue. My son was massively excited about this. He said, "Dad, this is interesting. Now, this is the same child at 14, at 28, will be having his own pension to manage. I won't be over his shoulder talking to him, and he won't be asking me questions. Guess what? He will be coming into this world via tokenized products, and he will be investing in really interesting things. And my younger son might find a way to invest in Pokemon via some tokenized cultural asset. He's going to be looking at that before looking at the S&P 500. And then I'm going to be the guy saying, slow down, maybe you need to be thinking about a 60-40 portfolio, you need to be thinking about some more diversification. But look at where this is going. So we're a way off, and the real world assets and all that sort of conversation is still a way off, but it's trending there, and I think it accelerates a lot quicker than even the whole ETF landscape did.
Yeah, some great point. I mean, certainly 24/7 for sure. And, in terms of the asset allocation, I have a wide range to choose from between 1% and 100%. So I'm going to comfortably go well in between. But I would actually just say that maybe more importantly, I think as I look out, it's less about whatever that percentage is, and more about, I think, the change in the breadth that you're going to see with just honestly, you're going to see this become more and more part of asset allocation models generally, whether it be ETF or otherwise. I also think there's a huge demand, and one of the things we're starting to see very early signs of is products themselves that provide some diversification to the asset. So not necessarily the allocation to digital itself, but a product that helps to allocate, across the spectrum, not just to Bitcoin, but to a spectrum of assets in terms of a basket of securities. And I think that's one of the sort of more intermediate term sort of developments that I would expect to see in some adoption there.
And maybe just add to what Jason was saying, thinking of the great wealth transfer that's incoming and Gen Z and Gen Alpha wanting to do things more themselves and the wallet infrastructure really making that possible. The ability to offer investment solutions, tokenized format, we're going to create all new business models for us to explore. It's really going to, I think, expedite growth longer term.
Thank you so much. Big round of applause. Thank you.